All right, let's put on our consultant hats today. We're going to decode one of the most fundamental parts of any business, its expenses. Understanding where the money is going isn't just some boring accounting task. It is literally the key to understanding the health, the strategy, and of course, the profitability of a company. Let's dive in.
So, how does a business really make a profit? I mean, it seems like a simple question, right? But this is the central challenge for every single company out there. It's not just about how much money you bring in, it's about what's left after all the bills are paid. The real answer is in mastering that relationship between what you earn and what you spend. Managing expenses isn't just about cutting costs, it's a seriously powerful strategic lever for success. So here's our game plan. First, we'll nail down what an expense actually is. Then, we'll build a proper consultant's framework to get all those costs organized. After that, we'll get into the two ways companies record expenses, how that all impacts the bottom line. And finally, we'll talk about the crucial role expenses play when it comes to taxes.
Okay, section 1. What is an expense? Let's start right at the beginning, at the very foundation of how a business makes a profit. Okay, so here's the official definition. An expense is the cost of operations that a company incurs to generate revenue. Put simply, it's the money you have to spend to make money. This is everything. We're talking employee salaries, office rent, the raw materials for your product, you name it. Every single one of those is a cost you take on, hoping it'll lead to more revenue. And this quote right here, this really gets to the heart of the whole thing. Profit isn't just about growing your sales. It's about the size of the gap between your revenue and your expenses. You could have sales that are shooting through the roof, but if your costs are climbing even faster, well, you're heading for trouble. The whole goal is to make that gap wider, either by pushing revenue up, pulling expenses down, or, ideally, doing both at the same time. But, and this is a really big but, it's not just a game of slash and burn on your costs. It is a very delicate balancing act. For instance, you could decide, hey, let's cut our advertising budget to zero. Your expenses would drop immediately, which, looks great on paper for about 5 minutes. But then what happens? Fewer people know you exist, your brand visibility tanks, and pretty soon your sales start to dry up. So the real takeaway is that smart expense management isn't about eliminating costs, it's about optimizing them. Okay, section 2, a framework for expenses. Look, to analyze potentially hundreds of different costs, we need a consultant's #1 tool for creating order out of chaos, a structured framework. So, to build our framework, we're going to use a principle consultants absolutely live by. It's called MECE, that's M-E-C-E, and it stands for Mutually Exclusive and Collectively Exhaustive. All that really means is that every single dollar the company spends will fit neatly into one and only one category. And at the highest level, all that spending can be sorted into two very distinct buckets. So here's our first big MECE split. On the left, we have the expenses we've been talking about. These are your day-to-day costs, salaries, utilities, marketing. From an accounting perspective, you recognize their full cost in the same year they happen. Then, on the right, you have capital expenditures, or CapEx. These are the big, long-term investments in things that will provide value for years, like buying a new building or a whole fleet of trucks. And because they last a long time, you don't count the cost all at once. It gets spread out or depreciated over several years. Now, for our purposes here, we're going to focus in on that expenses bucket. So let's double-click on that and apply our MECE framework one more time to break it down into its two core types. And this next split is absolutely crucial. First, you have your operating expenses. These are all the costs tied directly to the company's main business. Wages for your employees, the cost of materials for your product, rent for your office. Then you have non-operating expenses. These are costs that aren't really related to the core business mission, like interest payments you have to make on a loan or maybe a one-time cost from a big restructuring. Separating them is so powerful because it lets you see how profitable the actual business is, completely separate from other financial stuff. All right, section 3, the two recording methods. So we know what expenses are, but when do we actually count them? This little timing detail can completely change how a company's profit looks on paper. The most common method, and the one that's professionally accepted, is called accrual accounting. The big idea here is something called the matching principle. You want to match your expenses to the revenues they helped you generate, and you want to do it in the same time period. So with this method, you record an expense when you receive the service or use the asset, regardless of when the cash actually leaves your bank account. This example right here makes the whole concept crystal clear. Let's say you hire someone to clean your office carpets in December. They do the work, send you the bill, but you don't actually pay that bill until January. Well, under the cash basis method, the expense happens in January when the money goes out the door. But under the accrual basis, the expense gets recorded back in December when you actually received the benefit of those clean carpets. See? It matches the cost to the period where the work was actually done. Section 4, the bottom line impact. Okay, let's connect all the dots and see exactly how all these costs flow down to that all-important number, profit. Think of this as a simplified roadmap of a company's income statement. It's a journey. You start at the very top with all the money that came in. That's your total revenue. Then you subtract your operating expenses, those core costs, to get to your operating income. That number is huge. It tells you how profitable your main business activities are. From there, you subtract your non-operating expenses, like interest, to finally land on your net income. And that, my friends, is the bottom line. And when you strip everything else away, it all comes down to this. This incredibly simple formula, revenue minus expenses equals net income, is the fundamental equation of business. Period.
Okay, last section, and it's a critical one, expenses and your taxes. Because managing all this isn't just for your own books, it's absolutely essential for figuring out how much you owe the government, because legitimate expenses can really lower a company's tax bill.
The IRS has a very clear standard for what you can and can't deduct. It's a two-part test, and you have to pass both parts. The expense must be ordinary, and it must be necessary. So let's break down what those two words actually mean in this specific context. So ordinary just means it's a common and accepted expense in your line of work. For a coffee shop, buying coffee beans is ordinary. For an architecture firm, not so much. And necessary means the expense is helpful and appropriate for your business. It doesn't mean you absolutely couldn't survive without it, but it does mean it's directly related to helping you make money. That new CRM software? Probably necessary. A new yacht? Yeah, probably not. And the IRS is also very explicit about what you can't deduct. Personal expenses are a big no-no. Your business can't write off your family vacation. You also can't deduct money you spend on political lobbying or, and this is an important one, any fines you had to pay for breaking the law. These rules are pretty firm. So as we wrap this up, I want to pull way back to the big picture. After all these definitions and frameworks, it's easy to get lost in the weeds. But the most crucial point to remember is this. Every single expense, from the smallest software subscription to the biggest salary, represents a strategic choice. It's a decision to put company resources into one area with the hope of getting a return. And that leaves us with the ultimate strategic question, the one that every single business leader has to ask themselves constantly. When you're looking at a cost, you have to decide, is cutting this expense a smart way to save money and boost profit today? Or are you accidentally cutting off a critical opportunity for growth tomorrow? Answering that question, well, that's the real art and science of running a successful business.